Good morning, everyone. Let's get started. As panelists for this session, we have two great Philips. Philips Jefferson, Vice Chair of the Federal Reserve Board, and Philip Lane, Executive Board Member and Chief Economist of the European Central Bank. Around 30 years ago, they both completed their PhD in the United States and then together joined the Columbia University faculty together as assistant professors. And they worked in the same building. And after Columbia, they followed different paths. But after all, in the end, they have come to stand in the center of monetary policy formulation for the world's two most important currencies. And now they are sitting next to each other here in Tokyo. Today's topics, given the names of the two panelists, you might have guessed we will be talking about the Phillips curve. In a sense, yes, but not much about the movement along the curve, but rather about the temporary deviation from the curve or the shift in the curve due to supply shocks. We have 45 seconds, and I plan to ask each of them to make a brief introductory remarks on monetary policy response to supply shocks. They might refer to other broader issues to set the stage. And then I would like to ask a few questions to them, but I will make it sure we have enough time to get comments and questions from the floor. This session is open to the press, and your comments may be reported. So let me first ask Philip J. to make your initial remarks. Jefferson-san, please.
Well, thank you for that introduction, and good morning, everyone. It's an honor to be here at the Bank of Japan, and I appreciate the opportunity to speak with you today. I'm looking forward to our discussion, but first I want to share some framing thoughts. I will briefly discuss 3 developments in the global economy that I'm monitoring, and then I will update you on my outlook for the U.S. economy and the path of monetary policy. The first global development that I'm tracking is the significant increase in energy prices due to the conflict in the Middle East. The rise in crude oil prices poses downside risk to growth and upside risk to inflation around the globe. Elevated energy prices are particularly challenging for countries like Japan that are net energy importers. While being a net energy exporter buffers the U.S. to an extent against energy shocks, it is not immune to the effects of disruptions in global supply. Gasoline prices in the United States increased significantly since the onset of the conflict and remain notably elevated. I am watching whether higher energy prices will start to weigh on consumer spending. The second development that is the rapid advancement of artificial intelligence technology. As a central banker, I am optimistic about AI's promise to drive productivity and growth, though I am still monitoring its effects on the labor market and inflation. And the third development is the effects of disrupted trade flows on the global economy. Since the pandemic, there have been multiple disruptions to global trade that have affected both supply and price levels. Against this global backdrop, my focus, of course, is on the U.S. economy. Recent economic growth in the U.S. has been solid, though I expect a more modest pace of growth this year as households face increased energy costs. The U.S. labor market is broadly stable, with both hiring and firing at relatively low levels. I see risk to the labor market as somewhat skewed to the downside. Disinflation in the U.S. stalled over the preceding year, largely because of increased tariffs. In recent months, inflation moved notably higher because of higher energy costs. I expect inflation to decline later this year as the effects of tariffs and the energy shock wane. But I view risk around my inflation outlook as tilted to the upside. I remain firmly committed to returning inflation to the Federal Open Market Committee's 2% target, aligned with our dual mandated objectives of price stability and maximum employment given to us by the Congress. At our last meeting in April, the FOMC decided to maintain the target range for the federal funds rate at 3.5% to 3.25%. I believe this policy stance leaves us well positioned to respond to economic developments based on the incoming data, the evolving outlook, and the balance of risks. I have not prejudged the next meeting, and I look forward to engaging with my colleagues about the policy necessary to best achieve our dual mandated objectives. Thank you again for the opportunity to speak with you. I look forward to our discussion.
Thank you, Philip. You reminded us that the supply shocks we are facing are not limited to energy price shock, but it can also include productivity gains from AI and also trade flow disruption supply shock. Thank you, Philip. Can I now ask Philip L. to take floor? Lane-san, please.
So, good morning. Let me also express my thanks to the organizers. Very happy to be invited to this very famous annual conference. I think as was just indicated, and I don't know if it's intentional in the design of the title for the session, because when you hear the phrase supply shocks, it does mean it's not a one-size-fits-all category. So, I mean, I'm sure we will come back to the energy shock. But as Philip just said, I mean, obviously, if you're an exporter of energy, it's a very different world than if you're an importer of energy. With trade, it also very much depends on what sector you're in. So one of the issues for monetary policy, of course, is relative price movements. So how do you think about relative price movements? I mean, I've sometimes read people say, well, you know, relative prices have no implications for inflation. Well, that's a very specific scenario. So then you have productivity improvements, which indeed may be multi-sectoral, general purpose technologies like AI. Laura yesterday highlighted fertility and demography in general, but one of the big supply issues, by the way, in Europe in recent years is surprisingly strong labour force growth. Despite pessimism about demography, there's so much immigration into Europe, and also a fairly big rise in participation by over 55s, that the overall supply capacity of the European economy was better than we had expected. And then the other one is in the green transition. So the green transition is ongoing. I mean, the way we think about it is essentially it's a sectoral supply shock, essentially brown sectors, especially brown energy production, shrinking, and green sectors, especially green electricity production, expanding. So all of those, and I think this came up yesterday repeatedly in different formats, you have to think about, is this an anticipated shock or a trend, if you like? And some elements of this, like demography, the green transition, the anticipation of future gains from AI mean that you have this kind of front-loaded demand effects and the supply capacity kicking in later. On the other hand, with the energy shock, this has been immediate. It's a disruption. This is not expected, I think. And we had overnight and fairly quickly a big decline in global oil supply, which has been masked until now by the inventories, but that is not forever. So when we think about the energy shock, there's also the issue that this is not, if you like, a kind of really productivity shock in the energy sector. It's coming from a geopolitical dispute. And what's interesting in the history of oil prices is historically a lot of these disputes fade away. And so you do get the initial rise in energy prices, but then it reverts back to the original level. This particular episode maybe is not like that, in the sense of even if there is some kind of resolution, it's gone on for so long, maybe there's going to be a lot of repositioning, like what is the optimal inventory level for a country? What is the optimal diversification strategy across the energy mix? So in other words, there may well be a persistent element to what's gone on here, even if the acute phase comes to an end. So we have this shock. And of course, when we think about it from a monetary policy point of view, and this came up a fair bit yesterday, we have to balance the immediate cost push elements of it directly, fairly immediate indirect cost push, because the energy using sectors raise prices as well. And then in terms of the second round, even if it is essentially a price level effect, and again, around the world, the speed of the second round in terms of the labour market varies. In Europe, the labour market overall tends to move quite slowly, but it does move. So in other words, even if the initial energy shock starts to reverse, the second round will be with us for a while. And so when we have our medium-term perspective in monetary policy, the kind of vision for the overall inflation dynamic is going to be quite important. And this goes to some of which was covered yesterday, like in the David Lopez Toledo's paper on how expectations get formed. This is going to be an important issue is, the phrase yesterday I think was one shock after another. So even if all inflation targets are fully credible in the sense of I believe when there's no shocks, the central bank will deliver 2%. But if you believe that there's going to be a sequence of upside inflation shocks, and this is just the latest round of this sequence, then if you're trying to predict what is average inflation for the next 5 years or 10 years, you may come up with an answer above 2%, because the shocks drive you away from target, central banks bring you back to target, the next shock brings you up to target. And this difference between average inflation and the inflation target is, we can understand as professionals, but in terms of how people form expectations, probably the accumulated average, the moving average of inflation is a relevant issue. Let me come back to supply, because here our language about potential output can be a little bit limiting. I mean, at the ECB, when we talk about potential output, again, we think about where the economy is going, again, in the no-shock steady state. But what tends to happen with supply shocks, especially if there's a risk of rationing or just non-availability of inputs, is your near-term supply capacity could be a lot lower than your long-term supply capacity. And this is, I'm looking at Athanasius there, which is one of the lessons from the 1970s. Don't be fooled by saying, well, this is a temporary shock, potential output remains high, and therefore you can not overly respond. But if you have like a multi-year interruption in supply capacity, even if it fades away over a longer horizon, for monetary policy, that multi-year decline in potential output is important. Let me stop there.
Thank you, Philip. Now our list of supply shocks were expanded to include demographic change and green transition. And I found your distinction between indirect effect and second round effect particularly helpful. Often they are mixed up. Yesterday, Governor Ueda talked about past episodes of energy price hikes. And according to the note I jotted down, the implication he gathered from the episodes were central banks should not look oil prices in isolation. Initial conditions matter. Boundary between temporary and persistent inflation is not mechanical. It depends on changes in expectation and behavior. And oil price shocks are tests of the entire inflation regimes. What are the lessons, Philip, you distill from the past episodes? Do you agree with Ueda-san or not? Are the lessons valid for the current episode, or would this time be different?
Okay, so can you hear me? Okay, so when you say Philip, go ahead and start. You have to distinguish what Philip you're talking about here. Okay. And I will also note, I think we both spell our names with one L. Okay, so that's another commonality that we share. A positive one, I would say. So, okay. Well, thank you for that question. And I will start by just mentioning at a very high level what I think cuts across many of the episodes of supply shocks that Governor Ueda went through yesterday in terms of importance for monetary policy. First, I would say what's important is whether or not inflation expectations are anchored or unanchored. If we look at the episodes from the 1970s, what made them particularly difficult was that inflationary expectations were clearly unanchored. And when we talk about supply shocks, I want to also emphasize that these are episodes that are very harmful to people living their everyday lives. And I never want to forget that in terms of what we face as policymakers in terms of the well-beings of our citizens. So I would say unanchored expectations and the importance they play is a important lesson, which leads me to my second point having to do with the credibility of monetary policy in terms of keeping expectations anchored. And I think one of the great gains coming out of the episode of the 1970s was the establishment of central bank credibility, which allowed us to weather subsequent supply shocks with much less pain than would otherwise have been the case. And so that is a great asset that I think we have preserved to this day. And even in the most recent episode, there was a capacity to bring inflation down without an undue increase in the unemployment rate or an undue slowdown in growth. And that has to do with my view that credibility was still in place. And third, what's important is the structure of the economy. So in the case of the United States in the 1970s, it was a much more energy intensive economy, and so the adverse supply shock had a bigger real effect and a bigger effect on inflation. Whereas currently, the energy intensity of the economy is much lower. And in fact, we've changed status from being an importer of oil to an exporter. And so that makes the impact of the current shock, while still severe and still adversely affecting citizens in the United States, much less severe than it's been historically. So I categorize that third observation or lesson with regards to the structure of the economy. I'll stop there.
So I think I think it's actually helpful framing to think about these historical episodes in two ways. One is pairwise comparisons. So it really helps the discussion to say, okay, in what way are we similar or different to 2022, to 2008, 2011, to the 1970s? And the pairwise comparison, as was just said, with the 1970s, I think the big differences are indeed central banks and the population knows, or they cannot conceive of inflation being away from 2%, markedly away from like 5 years from now. It's just not in their frame of reference, and that is so different in terms of what happened in the 1970s. And as Phil just said, the energy intensity of the economy is different. On the other hand, compared to the 1970s, the amount of globalization is a lot higher. So, I mean, as Shebnem was presenting yesterday, when we're looking at the effect of the energy shock, it's partly directly in Europe, but we're also looking, okay, the increase in energy prices and so on, what's that doing to producer prices in Asia? And in turn, across all of the different imports we have, what are the channels there? So in terms of the kind of full global, multi-sector, multi-country, multi-stage production, you have to trace through the full global impact, as Shebnem was showing yesterday. It's very important. What I would also say, though, is the full history matters. So in the data set now, it's the 1970s, it's the 08, it's 2011, it's also 2022, and very important for us in Europe. And so if I localize to that, essentially what we learned, the big reveal for us at the ECB, maybe differently or similar in the Fed, was the non-linearity. You know, if inflation goes very high, then it kind of opens up all sorts of non-linear adjustment mechanisms. The scale of that also depends on the covariates about the initial setting monetary policy, the initial fiscal policy, and the level of demand. And remember, 2022 was just this unique configuration. So the war happened at the end of February 22. This is more or less when the European economy reopened after the pandemic. So those 6 months, this middle 2 quarters of 22, were relatively strong in aggregate in the European data. You might say, so I conclude a war is good for the European economy because there's a big recovery. And said, no, there's something else going on, the pandemic recovery. We don't have a pandemic reopening now. We have, kind of the European economy growing, but in a subdued way. So let me then say, okay, people now have absorbed the idea of non-linearity. But I think one important kind of selling point by the staff of the ECB is essentially it's not 0-1. In fact, the ECB staff kind of goes 0-1-2. 0 being small, 1 being mid-sized, and 2 being large. 2022 was large. So in the middle category, and I think we are in the middle category now, there is a degree of non-linearity, but it's probably convex. In other words, you're on a slope here, but it's not the same non-linearity as we had 4 years ago. And this kind of becomes a data issue, because a lot of people are trying to estimate on the time series how strong will be the pass-through and so on. And essentially, I think you have to recognize, ideally, you want to be able to estimate this reaction curve and locate where you are on that curve. So you can see, well, in 2022 we're over here, and now we're probably some midpoint of that reaction. So I would say we try to learn from all of those episodes and take the lessons from all of them. I suppose for me right now, it's trying to assess the exact scale of this shock and how long it's going to last.
Thank you, Philip and Philip. Yesterday, Don Kwon and many other people discussed the importance of monetary policy communication. And I would argue major supply shock make monetary policy communication both more difficult and more important. More difficult because the economic outlook becomes more uncertain and the policy reaction functions more complicated. And if we are to convey nonlinear function with 3 stages, 0, 1, 2, to general audience, it would be a highly challenging task. At the same time, it would be very important, as Philip Jefferson has already emphasized. The key is anchoring of inflation expectation and the credibility of monetary policy, and communication plays a pivotal role in attaining the 2 things. So more important but more difficult, very challenging situation. How do you meet such challenges? Lane-san, please.
So I think the overriding communication, which I think Don said yes, is to communicate that you're absolutely committed to making sure inflation returns to target in the medium term. So the initial shock is going to happen, but you have to say, look, that's our mandate. We're mandate driven. That's our commitment, and essentially we will set. And it's not just a hope. Like we hope inflation will come back to 2%. That you say you will set monetary policy to deliver that target in the medium term. Now, because of all the complexities, at least we've decided not to say, here's exactly the monetary policy sequence you need to return. We will be adaptive. We will be using the data to kind of navigate meeting by meeting. But that's all a kind of secondary message to the overall message. We will do what's needed. Now, right now, this is actually, in a sense of, I think, we're well positioned because we've already just gone through a cycle where we said, okay, inflation went sky high. We will bring inflation back to target in a timely manner. We're going to raise rates and then we'll normalize rates when it's over. So we just went through that full cycle. So now it's come again, and the question, is that we told you before, and we did it before, that we will deliver monetary policy to return inflation to target, and I think that's the most important element. So it's avoid complacency. So I think the lesson has been learned that you have to say this is a substantial issue, but also to avoid overreaction because of the demand destruction channels. You have to be skillful in terms of looking at monetary transmission, looking at consumer confidence, looking at all the different mechanisms so that your calibration of monetary policy recognises there are elements of a supply shock that endogenously do calm down the inflation pressures over time. But of course, overriding that is the expectation issue and making sure that there's no persistent belief in the population or among price setters that inflation is going to be too high for too long.
Well, Philip, the other Philip, very much covered much of what I was going to say, but let me just reiterate and emphasize that first and foremost is to communicate to the public that we're committed to our 2% inflation target. Now, I guess what I would add to what Philip said is that it's also important to try to help the public understand the uncertainties involved with a supply shock. And we can take the most recent example in that it's easy to see in the first instance from following geopolitical events what exactly is happening. But it's also the case that in the current situation it's very difficult to know about the extent and the duration of the shock in terms of how it's going to unfold. So to the extent in your communications, we can convey that there is increased uncertainty. And as a result of that increased uncertainty, it is difficult to say moment by moment exactly what the policy will be, because we're learning about the shock in real time. And so there's going to be this need to sort of update as we're going along. While the overall objective is to get inflation back down to 2%. And then with respect to this distinction between first round effects and second round effects, to the extent you can describe what that distinction is and convey a sense of humility to your public, that there is nothing that monetary policy can do with regards to the first round effects. You take the impact of energy prices increases in the United States. The first round effects are going to happen, okay? And monetary policy really can't do anything about that. What we can do is make sure that that first round effect does not convert into a second round effect, such that inflation expectations are impacted, such that we get into a wage price spiral. Okay, so I think it's important to not only communicate but to act in terms of policy. And this was a point that came out yesterday, to act so that the public understands our intent and commitment to returning inflation to the 2% target. I'll stop there. Thank you.
Thank you. Thank you very much. Helpful communication need to be backed by action. Okay. Now I would like to open the floor for comments and questions from participants. Please raise your flag. No. Yes, Athanasios, please.
Thank you, Chair. Since you ended with a question on communication, I want to explore a little bit more one of the challenges for different central banks related to the adverse energy shock that we are having. Depending on whether your economy is an energy exporter or an energy importer, there are vastly different effects on potential consumption, on whether the public should understand whether they're richer or poorer on average, not talking about the distributional consequences at all. So how do you deal with that in the communication and design of monetary policy? So if you're in Europe, for example, you try to explain that, well, like it or not, something bad happened in the rest of the world, so we need to adjust to that, help us with that, but we need to understand that this is a negative shock we cannot deal with from the central bank. In the US, it's much easier for the current shock. So I would like to explore a little bit this aspect.
So this is where I think being kind of granular in the data analysis is important. And it's actually only very recently in the EU area do we have high frequency surveys of firms and households. So it's only, more or less when I arrived, the staff were ready to launch the Consumer Expectation Survey, which is around 30,000 people across Europe. That has been really helpful because it's every month or every meeting round we have an update, and so what you expect is in the data, the lowest kind of quintiles are really, they consume a lot of food, they consume a lot of energy, they are really affected. And this is why having targeted fiscal policy that can smooth out the income shock to the lowest quintiles is kind of politically important, and to support consumption. So that differentiates saying, look, so avoiding the fact that there is a negative collective hit, to say for those who are really, highly exposed, maybe there should be a fiscal response. But for the whole population has to accept that there is a collective real income loss here. That I think for Europe, maybe it's different in America. I mean, Europe is so globalized. So whether it's the trade issues, whether it's kind of the rise of China, now the energy shock, essentially the European economy is so driven by external shocks. I don't think that's a major issue. People understand Europe is rising or falling in terms of its relative position in the world. And the energy shock is, I think, one element of that. But what I don't disagree is fiscally, right now, so far, the fiscal response in Europe has been contained compared to last time. But of course, this episode is not over. So I think for us, we recognise it. For governments, I think the communication issue is very challenging in terms of that distributional issue.
Well, for us, I think what all segments of society is noticing is the increase in energy and gasoline prices in particular. And, it's important that we are sensitive to how that's impacting the lives of everyday people. In this current episode, what makes the situation in the United States challenging is that the energy shock is not the only thing that's going on. So at the same time, we have the build out and expansion related to AI. And that's a driving force for investment, for instance. So it is the energy shock, I think, is something that is a headwind for growth, but we are still having growth during this episode. So in terms of monetary policy communication, again, the emphasis has to be on monitoring the second round effects associated with the supply shock and the surge in investment demand, and doing our very best to balance those second round effects with other factors that are taking place in the economy. So I'll stop there.
Okay, thank you. We have only 8 minutes left, and I see 3 flags. So let us take all the questions first and ask you to respond to the question which particularly attracted your interest. Marcus?
Yeah, I have 3 short questions. One is distinguishing between different types of supply shocks. So we know from the network literature it matters a lot whether a shock hits upstream or whether it's downstream. Do you make any distinctions across supply shocks along these dimensions? The second question is related to that, is does it make a difference whether a sector is hit which has a lot of pricing power and powers on the pricing, or is a sector which prices are fixed and is to take the hit fully, and there probably non-linearity is hit? Perhaps if a small shock, it will be absorbed by this sector. If it's a large shock, the sector might be wiped out. Is there anything which you take into account on this dimension? And the third question is about uncertainty shocks on supply dimensions, whether you also have a particular emphasis on that.
Thank you, Marcus. Governor Ueda, please.
Yes, I wondered if the panelists could expand on this interesting point made by Philip Lane as far as I understood it, it goes like we are probably into a world with lots of negative supply shocks, especially supply shocks to the foods and energy. Even though each of these will be just a price level shock, so the effect on inflation will be temporary. But because there will be lots of them, this could raise the average rate of inflation. And one response suggested by Philip, I thought, was for us to target a slightly lower rate than, say, 2% for the core to allow for the upward shift in the observed inflation rate arising from the series of supply shocks. I wonder what the welfare implications of such a strategy and communication challenges such a strategy would raise.
Thank you, Governor Ueda. Is that Asa's flag?
Yes, thank you, and thank you for a very inspiring panel. So you both mentioned the labor market in Europe and the US, and the labor market in Europe is much less flexible than in the US. And would that call for different monetary policies in the different continents? Would the second round effects be more severe in Europe due to that? Thank you.
Thank you, Asa. I see more flags, but we have only 5 minutes to respond to those questions, so I would like to ask both Philips to respond.
Okay. So those are very interesting questions. I mean, for the question asked by Marcus on upstream versus downstream, I mean, again, one of our basic baseline approaches now is, as Chevron showed yesterday, a kind of production network type approach. And actually the most visible issue for us with this, I mean, yes, the energy shock is one example, it's the China shock. So the China shock 1.0, as they say, was basically cheap final goods coming from China. Now it's basically cheap intermediates and at a higher level of technology. So the way they kind of permeate the economy are different. When I was in Singapore last week, my speech focused on this issue, so that's advertising. Absolutely, the pricing power issue is there. And this is where there is a kind of so I made this distinction within the first round between the direct and indirect. And again, I mean, the fuel prices, as Philip said, like at the petrol pump, that's immediate. It happens within days. So it's kind of totally rapid. But then for us, we had to move our analysis of energy prices, because the consumer energy price, it's a mix of long-term contracts. It depends how much hedging is done. So even the energy shock itself, there's a pricing issue here, including going back to the issue about uncertainty, how much one response to uncertainty has been to do a lot of hedging, and who's the counterpart of that hedge. The uncertainty, I think, will last in terms of, I think, everywhere I'm hearing, never again am I going to carry low inventory. I need to have a lot of inventory, both energy inventory and also, so the kind of, that can be a boost to the economy in the near term if basically people are demanding more supplies to build inventory. I think that could be important. I think the question about the flexibility of the European labour market is what's interesting is historically, if you go back to Ned Phelps and Blanchard as well, was when they said the European labour market was rigid, they meant a lot of indexation. So there's real wage rigidity. I'm not saying, real wages moved a lot last time because there's a lot of nominal stickiness in European wage contracts. With the unemployment rate now a lot lower in Europe, I mean, the question about would we, if we had a big kind of dynamic sector in Europe, like, would we have the flexibility to move resources across the economy? That's an interesting question about, but I'm not so sure that's the first issue right now. But then Governor Ueda has really nailed an important issue. So, for a long time in Europe, inflation was at around 2%. But as core inflation being around 1.5%, and then before the global financial crisis, on average, oil prices are growing quite strongly. So it's an interesting question, which is, I mean, I think the idea that headline inflation around 2% is a sweet spot where people don't notice it so much, but it's not so low that it creates kind of adjustment difficulties. But the implication is, if you conclude there's a real trend in the data about the relative price of energy and the relative price of food, it does imply something about the if you like, target core rate. So for energy, the issue is it's not clear, because the rise of renewables should mean lower energy prices in the future, because the prices it should mean less volatility because you're less exposed to fossil fuel holder problems. So I think people have visions of near-term energy prices maybe going up, but longer-term energy prices coming down. And for food, I mean, there has been an upward drift in the relative price of food, but it's not so spectacular that I think you necessarily need to make a big adjustment. So our focus last year when we did our strategy review, which focused on all of these shocks, was basically more inflation volatility. We didn't draw conclusions about the average inflation rate. It's just it's going to be moving up and down quite a bit. And this goes to the issue of, for me, a big second round issue. It's not about inflationary expectations. It's basically about the cost of living. And Kristen Forbes has written a lot about this recently, which is basically, if the price level goes up, unless the labour market is really weak, households want to get back to their old real wage. And in a European context where fairness is a very important driver of the wage bargain, and quite often that goes through legislation in terms of minimum wage and other points. That doesn't get around what Athanasia said, should you be trying to recover the old real wage if there's a kind of genuine move against you? But what happened in Europe is it's the old real wage statically. If there's a kind of upward drift in productivity, getting back to the old real wage statically is below the trend real wage, and that's where the real adjustment can take place. So this issue about fairness, people wanting to feel that they are being fairly compensated, a cost of living increase that comes from some external factor, people feel that's unfair to suffer too long from that. So I think that's a really acute question you asked. Thank you.
Thank you very much, and I will try to speak quickly, being mindful of our time. So in the United States, we have a dual mandate. So it's price stability and maximum employment. And to Governor Ueda's question, what has been my observation is that over long periods of time in the United States, when price stability has been established, that has led to longer-term, non-inflationary economic growth. And what we see in those episodes is that prosperity is very broad-based, it is very inclusive, and we see a tightening of unemployment rate differentials across different demographic groups in the United States. So what that leads me to believe is that if you establish price stability, that creates a framework for growth in which more segments of the population will benefit and be better off than would otherwise be the case. So establish price stability, that creates the framework for long-run economic growth, increased prosperity, more people included in the labor market, and lower unemployment rates. So that's my view on that. Now, with respect to the question about labor market differences, because in the United States, we do have this dual mandate, and so I, as a policymaker, am mindful of what's happening in the labor market. So as I'm thinking about my policy decision from meeting by meeting, Absolutely, I'm focused on reestablishing price stability, defined as 2%. But by mandate, I also have to keep in mind what's happening in the labor market. And the U.S. labor market, through this current shock, has been very resilient. And so given that resiliency, it seems appropriate that focus would be on returning inflation to 2%.
Okay, thank you. We've run out of time, but I hope two panelists would be prepared to respond to further questions during coffee breaks and lunch. Please join me in thanking both Philips in sharing their insights.